Good evening, everyone. So we'll be looking at financial reporting (FR), and our topic will be the continuation of last week's topic on IAS40 investment properties. Last week we talked about the objective of the standard. So what are the objectives of the standard? We talk about the definition of terms. So we'll define the terms under the standard. We'll talk about the examples of examples of investment property. We are saying how will a particular property, be it land or building, be classified as what? Investment property. So we said if any property, either land or building, is held for capital appreciation, or is held for rental purpose, or it's held by the entity without knowing the actual purpose or its immediate usage. So during that period, it should be classified as an investment property. We'll talk about things that are not classified as investment property. Those properties which are not classified as investment properties. So this is covered by IAS2 and IAS11, which is IFRS 15 now. Revenue with contracts with customer, and IAS16, owner occupied property. They are not investment property. We talk about the scope of the standard. The standard talk about the recognition, measurement, and disclosure of investment property. So last week we talked about the scope. We'll talk about the recognition criteria, the two major criteria, the revenue. Before you can say a particular property is classified as investment property, or you saying the benefits that are accrued to that property should flow to that entity. And we said that the cost or the fair value of that property should be measured reliably. And we'll talk about the initial measurement. What is the initial measurement? We'll talk about how we IAS40, which is investment property, be measured initially. We said it must be measured initially at cost. And what constitutes the cost? We said this follows the concept of IAS16, initial measurements. We talk about the purchase price of that asset, the non-refundable taxes, the directly attributable costs. They are also part of the cost of that asset. We'll talk about the subsequent expenditure. We said there are two major, which is recurring expenditures and capital expenditure. Recurring expenditure are those expenditures that we occur day to day in the cost of operating that investment property, and this should be expense in our profit or loss account. Why the capital expenditure should be capitalized in our SFP to the cost of that asset. I will talk about measurement subsequent to initial recognition, which is, we said the entity should choose using cost model or fair value model. So we'll define what is fair value model in our last week, and we'll talk about the exceptional circumstances, and we'll talk about the cost model. What makes the cost model, which you already know, which is the initial cost of the asset less the depreciation and any impairment. We'll talk about the change in method. That means you can change from your cost model to fair value model, but the standard does not allow any change from fair value model to cost model. We are saying the fair value model is preferable than the cost model according to IAS40 to measure investment property. Last week we also talk about the transfer. That means you can transfer from owner occupied property, which is IAS16, to investment property. So today we'll look at the question that we discussed about the transfer. And we also talk about you can transfer from IAS2 inventory to investment property. I also transfer from investment property to IAS2 or IAS16. So I will look at this illustration last week. I hope we understand the question, the illustration very well, and the solution. So if there's any questions, we should be able to tailor it to us. Ask the question via our WhatsApp handle, our WhatsApp group. Today we'll be looking at disposal of investment property. the disposal of investment property. Now, when we say disposal, we're talking about to derecognize an investment property, to sell an investment property. So, investment property should be derecognized, eliminated from the statement of financial position on disposal, or when the investment property is permanently withdrawn from use and no future economic benefit are expected from its disposal. Any gain or loss on disposal is the difference between the net disposal proceed and the carrying amount of the asset. This disposal is always is similar to that of IAS16, and I could remember no one replied the assignment or sent the solution to assignment, which were in the assignment in IAS16. In the last part of IAS16, we'll talk about disposal, and I gave a question which I tell as an assignment. So no one solved the assignment and sent the solution to me for me to review. So I believe we understood the question, and the solution is well understood. So because when we ask question, it shows that okay, the lecturer need to explain more. But when we keep mute, we don't ask questions. So the lecturer believe that we understand the topic and the illustrations. Now, the disposal, I will say the difference between the disposable proceeds, which is the sales value, and the carrying amount is treated as our as a gain or loss on disposal, and which should be recognized in our statement of profit or loss account, or statement of profit or loss and other comprehensive income. So let's look at this illustration 2. Illustration 2. Now we said Sporting Braga PLC owes 3 investment property X, Y, and Z. The fair value of which is as follows. So the fair value of the property X, property Y, and property Z as at December 2014 and December 2015 were given as follows. The original cost of the property were 20 million each when they were purchased on 1st of January 2013. The entity uses the fair value model to value all its investment properties. So you are required to show the financial statement extract for each of the 3 years ended 31st of December 2015. So you are asked to show an extract of the financial statement. Usually, the statement of profit or loss and the statement of financial position. These two statements are the statement we should always provide when we say we should show an extract of financial statement. So we are told that a particular company, which is Sporting Braga, has 3 investment property, which is X, Y, and Z. And we are told that the cost as at 1st of January 2013 is 20 million each. Now, let's look at the difference in the fair value in each year. It will give us if we have a fair value gain or a fair value loss. Now, let's look at our workings. Now, in 2013, as at December 2013, we are not giving the fair value. So we are looking at in 2013, there is no fair value gain nor loss in December 2013 because the cost of the asset as at December 1st of January 2013 will be the cost of the asset as at the end of that same year, which is 31st of December 2013. So we compare the cost with the first fair value of that property. Now we are told that the first fair value day of that property, which is property X, Y, and Z, is 27, 18, and 26. 27, 18, and 26. And we are here. The property X, the cost is 20 million. The fair value is 27 million. So we have fair value gain gain, fair value gain for property X. Property Y, the cost is 20 million, while the fair value is 18. So we have fair value loss. That's why it was bracketed. It was a bracket. Property Z, the cost is 20 million, while the fair value is what? 26 million. So we have a fair value gain. So the increase within the cost and the fair value, which is 6 million. In 2015, we have a fair value gain in property S, because the fair value for 2015 is 32, while the fair value, the opening fair value, which is the cost, is 27 for X. For Y is 6.5. Y for please Y from Z. For Z, we have fair value loss. Please, it's jacketed, so I have to correct it. Fair value loss, which is a fair value loss of 2.5. Fair value loss of 2.5. Please, that 2.5 should be jacketed. Now, when in our profit or loss, how we going to account for it? Our fair value will be, any gain will be credited, then I will debited to the cost of that asset. So that is why I show it in our profit or loss, the fair value of 7.5. For 2013, there is no fair value gain nor loss for 2013, but 2014 and 15, it been showed the total for the 2 years is 11 and 9. Why our system of financial position is being showed, which in 2013 the cost will be the closing cost of 2013. Why for 2014? For 2014, the fair value is what will be shown as the declining amount for 2014 and 2015. You should always remember that the accounting treatment for fair value gain is credit profit or loss and debit the cost of that asset. Why fair value loss is debit profit or loss, then credit the asset. That is the accounting entry for to treat fair value gain nor loss. Now let's look at this illustration 3. This illustration 3 talks about the transfer of a property either from IAS16 to IAS40. So let's look at this illustration very well. This illustration is very lengthy, and I should be able to read it and understand it very, very well. So we have within 5 minutes to read this illustration 3. I understand it. Now let me read the question for us. Illustration 3. An investment property company has been constructing a new cinema. At 31st of December 2012, the cinema was nearing completion, and the cost incurred to date were, so we are giving the cost incurred to date, which is for material, labor and subcontractor, for other directly attributable overhead, and the interest on borrowing. So these are the costs incurred to date. That is to 31st of December 2012. Now, it is the company policy to capitalize interest on specific borrowing raised for the purpose of financing a construction. So this policy follows the principle of IAS23 borrowing costs, because the amount of borrowing outstanding at 31st of December 2012 in respect of this project is 18 million. So 18 million is the amount borrowing, and the annual interest rate is 9.5%. During the 3 years to 30th of March 2013, that is from 1st of January 2013 to 31st of March 2013, which is 3 months, the cinema was completed. So the cinema was completed after 31st of December, sorry, 31st of March 2013. That's when it was completed, and the cost incurred to completion was 1.7 million for material labor and subcontractor, and overhead 0.3 million. The company was not able to measure the fair value of the property reliably during the construction period, and so value it at cost pending completion as allowed by IAS40. So during construction, the asset was valued at cost. On 31st of March 2013, the company obtained a professional appraiser of the cinema, the fair value, and the valuer concluded that it was worth 24 million naira. The, the fee for his appraiser was 0.1 million naira, and has not been included in the above figures for costs incurred during the 3 months. So we are told that the 0.1 million naira, which is 100,000, was not part of the 24 million naira. The cinema was taken by a national multiplex chain on an operating lease as at 1st of April 2013, and was immediately welcoming capacity crowds. Following a completion valuation of the company's investment properties at 31st of December 2013, the fair value of the cinema was established at 28 million naira. So now we are giving different costs for different periods or different months. Now for 31st of December 2013, the fair value was 28 million naira. But in March 2013, the fair value was 24 million naira, and we have the cost prior to that date, prior to 31st of March 2013. Now you are told now set out the accounting entries in respect of the cinema complex for the year ended 31st of December 2013. So we are told we should look for accounting entry. Accounting entry is what to debit and what to credit. Now, in this scenario, I will explain this illustration bit by bit. Now the illustration. Now the first thing we have to do that we have to know the cost incurred to date, which is prior to 31st of December 2012. So the cost incurred, you have to debit the assets. You have to debit the asset under construction, which is the cinema under construction, because as at 31st of January 2013, the asset was under construction. So you debit it. Any material purchase should be credited, which is the material, labor, and subcontractor should be credited, and you debit the asset that is under construction, which will show you have a property. So that's why we debit asset under construction, and we credit those material and labor, then subcontractor, and then the interest expense. We are told that interest expense should be capitalized, so that's why we debit the asset under construction and we credit interest expense. So as at that particular date, our total cost incurred, or the value of that asset under construction, is 18.6 million naira. Now, on cost incurred to 31st of March 2013, so those costs, we are told that the cost incurred is 1.7 million for material and overhead, which is 0.3 million. So it should be debited to the asset under construction, and you credit their respective accounts. Another thing should be debited is the interest expense. And how do we get the interest expense? Let's look at the workings for the interest expense. Now, for the interest expense, the interest cost is 9.5%, which is annual cost, and we are capitalizing the period from 31st of December 2012 or 1st of January 2013 to March, which is 3 months. So it's only 3 months that will be capitalized, not the whole 12 months. So that's why I put it to 3 months. So the month during construction, that is prior to the date where the assets were being completed, that is what will be capitalized. Why the rest will be expense. Why the rest will be what? Expense. So the extra 9 months will be expense. As we have the 0.43 million. It was capitalized. Now, the total cost down to the date in which the fair value was ascertained, we must ascertain the total cost. Now, the cost to 31st of December 2012 was 18.6 million naira, while cost to March 2013, when you added it together, was 2.43 million naira. When you added it together, the total cost incurred to March 2013 was 21.03 million naira. So that is a cost as at that period. Now we are told that as at that date, the company now want to value the asset using the fair value, which is as at that March 2013. They now call the valuer. Then the valuer now ascertain the fair value, which is to be 24 million naira. Now, and the professional service, that the cost of the valuer, the professional fee for that valuer was 100,000 naira. We are told that it was not included in the fair value. It was not included in the fair value. Yes, that 1 million naira or 100,000 naira will not be part of the fair value. Will not be part of the fair value. Will not be capitalized, because prior to that period, the asset has been already be completed, so we know the value of the asset. So the professional fee is not directly attributable to the construction of the asset. It was after the asset was being completed. So the 0.1 million naira would not form part of the cost of the asset or part of the fair value of the asset. So that 0.2 million will be expense. So if we are told that in our exam that professional fee was part of that asset or part of that 25 million, so we must subtract it from it. So that will we capitalize. So the difference between the fair value, which is the 24 million, and the 21.03 million was 2.2 million 970,000. So that is 2.97 million. So that is our fair value gain on completion of that property. So you debit the property and credit profit or loss as a fair value. So this is our accounting entry. So I gave us a note why the professional cost was not part of the cost of that asset. Now, as at the 31st of December 2013, our fair value was now 28 million, which is as at the 31st of December 2013. The difference between the fair value of 24 million and 28 million is 4 million. So we debit our asset and credit profit or loss account. So with this, we should read this question very well and understand the accounting entry. Let's talk about the disclosure of the standard. The disclosure. What should we disclose relate to that standard? To IAS40, we might be asked in our exam. State list 5 disclosures according to IAS40. So these are things we should be able to list. 1, the choice of the fair value model. So we should disclose the choice of the fair value. We should tell it, okay, the company uses the cost model, or the company uses the fair value model to value its investment property. 2, the criteria for classification as investment property. You are given the criteria when you classify as investment property. We are told the criteria is 1, the fair we are told that the revenue the future revenue attributed to that property should flow to the entity, and the cost was measured reliably. So the criteria must be there, and it must be another criteria is that the asset, before you can classify as investment property, it must be held for capital appreciation or for rental. So these are the criteria for you to recognize as investment property. So the criteria, we must tell the criteria. The assumptions in determining the fair value. What are the assumptions to determine the fair value? How do we arrive at the fair value? What are the assumptions? We should also disclose it. The use the use of independent professional valuer. So we should be able to tell the disclose it if the company uses an independent valuer. Then the rental income and the expense. What are those rental income? What are those income? What are the income? The fair value gain and the fair value loss. We must disclose it, and the expenses we must also disclose it. And if there any restriction or obligation in relate to that investment property, we should be able to disclose it. Now, the fair value model additional disclosure. So when you are using fair value model, you should be able to disclose this additionally. You should disclose the reconciliation of the kind amount and the investment property at the beginning and at the end of the period. So the reconciliation, which is the opening carrying amount, which is the fair value, and the closing fair value, the reconciliation, which is the difference, we should be able to disclose it. If you are using the cost model, this relates to mainly to the depreciation method. Which will, when you are using cost model, you will tell us which depreciation method you are using. Are you using the straight line method? Are you using the reducing balance method? Are you using the sum of the digit method? So all these methods you should be able to disclose it. The depreciation method and the useful life of that investment property, you should be able to disclose it. So when you are using the cost model. So with this we've come to the end of tonight's class. See you next week.